All right, everyone. I want to welcome you to today's Headway Capital Passive Investor Series webinar. Today, we're going to discuss cash on cash for passive real estate investors, or maybe you're an active real estate investor looking to get active in the commercial real estate space. You want to invest in apartments, you want to invest in multifamily, you want to take part in syndications. Well, you've probably heard terms thrown around like cash on cash, and maybe you're not quite sure what that means. So today we're going to break it down and discuss what is cash on cash so you can have a better understanding of the term and know what to look for the next time you're looking to invest in multifamily or commercial real estate. Let's dive in. All right, so real quick, just a few housekeeping items. If you want these slides, text us 281-559-7061. I will reply back myself personally and send you over these slides. Shoot me a text, say, hey, Brian, send me the slides from tonight's webinar. Just make sure you include your email address as well, and I'll be sure to send these right over to you. And I just want to say thank you to today's sponsor. Today's sponsor for today's webinar is the Magani Insurance Group. So if you're looking for insurance for your property or your business, reach out to MIG. They are one of our trusted partners. They insure all of our assets and all of our businesses are on the liability side and on the truck side for some of the other vehicles that we have in our business. They take great care of us, and they'll take great care of you. So shoot an email over to ajmagani@insurewithmig.com or go to insurewithmig.com. Let them know Brian and Sid sent you over from Headway, and they would appreciate. They'll take good care of you. We'll appreciate the referral. Just a quick disclaimer, this webinar is for educational purposes only, should not be considered legal or investing advice. This information on this webinar does not represent an offer to sell or solicit. We're not selling anything here. We're just educating. And of course, before you make any investment decisions on anything you hear about here, you should always do your own due diligence, consult your attorney, your financial advisor, and your CPA for legal matters before you take any action. Let's dive in and talk a little bit about us over here at Headway. Headway Capital was designed to build and protect the wealth of busy professionals. So what we do is we provide alternative investment opportunities in the commercial real estate space with a focus on multifamily, value add components, so deals that have some meat on the bone. We provide these investment opportunities to our investing partners. Very commonly, they are accredited investors. So that just means that they have a certain income or they have a certain net worth over $1 million, and they're looking to diversify their portfolio. So we started Headway Capital back in 2018. That's also when we started our vertically integrated property management company. Sid Shamim is our founder and CEO. After many years of investing in residential housing, he had 30, 40 houses, quite a residential portfolio. Him and his wife, Anam, transitioned over to passively investing in real estate. So if you're on this webinar, you're listening to this webinar, and you're thinking about getting started in real estate, one of the multifamily real estate, commercial real estate, one of the best ways to get started, and the road that is very commonly followed, is they passively invest first, which is exactly what Sid and Anam did. They invested passively in several syndications, several partnership deals, and eventually transitioned to buying their own deals and providing those investment opportunities to people that were in their circle, friends and family. And over the years, the investor list grew, and here we are today. My name is Brian Alfaro. I'm the Director of Investor Relations here at Headway Capital. My job is to help educate our investors about all our alternative investment offerings in the multifamily and in the fund space. I talk to all of our investors. I screen them. I get on calls with them to build relationships with them. We don't just like to take your money and give you your checks, although that's, at the end of the day, that's what business is about. We definitely want to build a relationship with our investors because relationships make business easier. They make it easier to communicate, which is what it is all about. And then the last but not least, you'll see Mr. Umar Naqvi. He is our Chief Financial and Investment Officer. He helps us do all of our financial due diligence on any assets we are acquiring. He has years of experience in the multifamily space before joining Headway. And obviously, he's a numbers guy. He loves spreadsheets. So he makes the whole thing go on the back end to make sure our investors are earning their returns. A little bit about the Headway core values, how we like to do business, what we stand for. First thing is always transparency. We love being transparent with our investors. It's the cornerstone of our business. We always do big business with integrity. So we are committed to being honest and ethical with all of our investment opportunities. We keep a very lean operations, which is important for all of our investors. They like that we're lean. We don't have 250, 300 people on our team. We only hire people when we need them, and we try to make sure we are diligent about our operations so that we can return more capital to our investors. investors. We're very accountable. We hold ourselves accountable. We hold our team accountable. Our investors hold us accountable. So we have a fiduciary responsibility to hold ourselves accountable, so we can make sure we are putting our investors first, which is our last core value. Is we always put our investors first. Our mission is to meet our investors' goals and objectives. So we want to make sure our investors get paid first before anything else. And that's what makes the Headway difference. So you'll see 3 of our lovely assets here that we've had over the years. Our current portfolio sits a little over $530 million of assets, 3,000 plus units, and we really target a 25 to 30% average annualized return. And we do have over 400 active investing partners. So we'll talk more about us at the end if you're interested in partnering with us and investing with us. But this is the Headway difference and what makes us unique. Let's dive into today's webinar topic, why everyone's here. Got quite a bit of people signed up for today's webinar, which I always find interesting, which topics are more attractive than others. And this is one that I see a lot of people were attracted to. So I'm excited to talk about it. So let's talk about cash on cash explained for passive investors. Now, maybe you're not a passive investor, and that's okay. I'm assuming not everybody on here is a passive investor, and that's okay. But you are curious on what the term means. What does cash on cash mean? What are these terms that I hear thrown around? Let's dive in and start talking about that. So the first thing I want to start with when talking about a multifamily, when talking about commercial real estate investing, if you are a passive investor or you're just learning about the business, one of the things you're going to commonly see is a lot of what I like to call acronyms, or what are called acronyms. It's kind of funny. We speak our own language in the commercial real estate space. I like to joke, if you've never been in the space before, you're new to commercial real estate, you're probably like, well, what are all these terms? I mean, why do you guys talk in acronyms? Or why do you see these acronyms all over the slides, right? So today we're really going to talk about cash on cash. So you'll see here there's 4, and they all have acronyms. One is capital C, lowercase o, capital C. That stands for cash on cash. That's what we're talking about today. Other potential terms you might see on an offering from us or from other potential groups that offer alternative investments is IRR, or internal rate of return. We're not talking about that today, but that's another very common one. They all mean something different. The third one is average annualized returned, which is AAR. So that's a very common one that kind of encompasses what is your total average annualized return when the deal's all said and done, between cash flow, between equity upside. So it's average annualized return. It's your total return divided by how many years you're holding the deal, 3, 4, 5 years. And then the last thing is equity multiple. This is one of the more common ones, one of the more easy ones. It's where a lot of people usually think when they think about real estate investing. They say, hey, they keep it simple, and we love to keep it simple. Equity multiple would be, hey, I'm putting 100K in. How much am I getting out? Or I'm getting out 200K. Okay, so that's a 2x multiple, right? So 100 times 2 is 200K. It's a 2x multiple. It's a 2.0 equity multiple. So it's the easiest one to think about is, if I put this much in, how much am I getting out? And that's a very common one that a lot of investors use. Some people don't care about cash on cash. They don't need the cash flow. They don't want the cash flow. They just care about getting the pop on the back end. They want the equity upside, so they focus on equity multiple. But today we're going to talk about one of our favorite topics, cash on cash, because cash is king. Cash is what keeps deals afloat, in my opinion. So let's dive in and talk about it. So what is cash on cash? What does that mean? One of the more popular terms you'll hear when it comes to cash on cash is the term yield, right? So yield is a common term. Some people might not say, what's the cash on cash? They would say things like, what is the yield, right? So that's a very common term in our space. The other way to think about cash on cash is cash flow, right? So cash flow is another term for cash on cash. It kind of shows you how much cash flow am I getting. Cash flow is a dollar amount. Cash on cash is a percentage amount, right? So they're very similar. They're basically the same thing, but one is in a percentage, one is in a dollar amount. And the reason cash on cash is so useful is because it'll, versus a cash flow, is it allows you to get a quick snapshot of the investment profitability, right? It allows you to kind of compare, I would say, apples to apples, right? So if you're looking at 2 real estate investment deals, or 3, or however many you're looking at, and one has a 7% cash on cash over 5 years, and one has a 8% cash on cash over 3 years, you can see just by putting those right next to each other, which one has a higher return over a certain amount of time versus which one has a lower return on a certain amount of time, right? So it allows you to have a quick snapshot of the investment cash flow and profitability of a particular deal and compare things apples to apples. If you were to talk in dollar amounts, it could be very, very, very misleading, right? Because what if that first deal I mentioned had a lower cash flow percentage, but the dollar amount was really high because it was a massive deal, right? Or what if the second one had a really, really high cash flow percentage, 15% cash on cash, but the dollar amount was really low because it was a really, really, really small investment, right? So it's important not just to look at the dollars and the percentages. We'll talk a little bit more about that, but the percentages really give you an overall perceived. If you're comparing two things, it gives you a little bit more to go apples and apples. The one thing that's really, really, really important to know about cash on cash is it does not it does not take into account the equity, right? We're strictly talking about the profit that the property generates when all bills are paid pre-tax that is able to be distributed to our investors. And we're going to go over the formula here in a second. But it's really important that you understand it and understand the difference between cash on cash and some of the other ROI metrics. And obviously, if you're a passive investor, this figure is crucial because it reflects the income that you can expect to receive on your investment, right? It makes it an immediate thing to pop out of you, an immediate measure of investment performance, right? So if you see, to keep it simple, and we'll go over examples here in a second, a certain percentage, it's very easy for you to know, hey, how much cash am I expected to receive year 1, year 2, year 3, year 4, year 5? And then what's the average cash on cash over the life cycle of a project, right? So when you're looking at an investment, the cash on cash will show you this, right? So it's important to look at year 1, all the years of the investment. Some deals are 3 years, some deals are 5 years, some deals are 7 years, 10 years. However, we do deals here that are 3 to 5 years here at Headway, but some could go longer if you're investing at other firms. All right, so it's important to look at the cash on cash from a year to year basis. And then the number that's usually in the marketing material, sort of as the introduction to the numbers, will show you the average cash on cash, which is just going to be the cash flow from all the years of the deal. So if it's a 5-year deal, we'll add up all the cash flows from year 1, year 2, year 3, year 4, year 5, divide that by 5. That's your average cash on cash for that life cycle of the project, right? So it's really, really important. But again, just something to make sure you are looking for when you're looking at deals. So let's go over the formula real quick, right? So let's go, skip ahead way too fast. Let's go over calculating cash on cash. How do I calculate cash on cash? And I want to keep this extremely simple, right? I didn't want to pull out massive numbers with millions of dollars and cents because that's what it looks like when you're looking at these a little bit more complex P&L statement and cash flow statements. When you're looking at like a T12 on a multifamily deal, and you're looking at all the income, you're looking at all the expenses, you're looking at the debt service and all this stuff, it can get really long and really confusing, right? You're looking at trash, you're looking at all these different things. So we're going to keep it simple in this example and talk about how can you calculate cash on cash if you're just doing a basic example. It gives you sort of an overview of how it works, right? So in this example, we have, and let's go over the formula first. So the formula for cash on cash is the annual cash flow from a deal, right? Pre-tax divided by total cash invested into property, right? So on a very, very large deal, a multifamily deal, it's not just going to be the 100K that you put in or the 50K you put in, or if you put $250,000 in, whatever it is, the formula that you see is going to calculate all the cash invested into the property, right? So that is every dollar, all your CapEx dollars, your renovation dollars, all the money that's put into the property would be the number that's at the bottom of the formula, right? The denominator, right? So it's the total cash invested into the property, not just your cash invested into the property. So, there's a lot of equity at play in these large deals. For easy math, let's say there's $1 million of equity and we find 10 investors to put in $100,000 each, right? The equity is one piece of that, but there's also the other parts of the total cash invested. There's the CapEx, for example. If you have $1 million in renovation, now that the denominator's $1 million in equity plus $1 million in of renovation, now you're at $2 million for your denominator. So it's the total cash invested into the property, right? The numerator, the top number, is the annual cash flow. So how much cash flow are we getting from year 1? How much cash flow are we getting from year 2? cash flow we're getting for year 3, and so on and so on, divided by total cash invested into the property, right? So that's going to be your formula for cash on cash return. So for the sake of simplicity, let's just keep it super simple. And let's assume you're buying your own deal. You're not investing as a partner. Maybe you're buying a single family house. It's a great way to kind of thinking about it. Let's say you invest $100,000 into a project, cash invested $100,000, right? Maybe the purchase price of the home you're buying is $80,000. Maybe you're putting $15,000 in renovations. That's $95,000. And then you got $5,000 in closing costs, right? So you got a total of $100,000 of cash invested into the property, right? Let's say your year 1 distributions or your year 1 cash flow that you get from that rental or from that investment, and whatever it is, doesn't matter what asset class it's in, is $6,000, right? So annual pre-tax cash flow is $6,000. In this example, you would take the $6,000 of cash flow that you're getting divided by the total cash invested, right? That's going to include your down payment. It's going to include your closing costs. It's going to include your renovations that you're putting in, which is $100,000. That's going to produce a 6% cash on cash return, right? So very, very, very simple, very elementary formula. It's not a very complicated formula. It's one of the easiest ones to follow. The more complicated formula is actually IRR, internal rate of return. It actually requires you to use Excel. I'm sure there's somebody out there that can do it by hand, but very, very, very few and far between. It's a very complicated formula because it takes over the time value of money, or the time you're invested into the project, I should say. Cash on cash is very simple, right? How much cash did I get out? How much cash flow did I get out from a dollar amount divided by the total amount of cash invested into the property? That's my cash on cash for a year, right? So it's a very important number to understand and very easy number to calculate when you're looking at somebody's underwriting or when you're looking at investing. So let's, and again, I forgot to mention this at the beginning, but if you have any questions, please, please, please put them in the Q&A box. I'll be happy to answer them at the very end. So let's talk about let's move on to the next slide, and let's talk about why cash on cash matters to passive investors or to any investors, right? So this is really, really important. So the cash on cash is a direct indicator of your yield or the liquidity available after all bills are paid, right, on an asset. So no cash flow, more risk, right? Nobody, well, let me rephrase. I'm not going to say nobody. It's not as common nowadays that people want to invest into projects that don't have cash flow. Now, you might not need the cash flow, but you still want to see the cash flow, because cash flow, in my opinion, or cash on cash, whichever term you want to use, remember they're interchangeable in this environment. It is a safety net, right? If you have cash flow in a property, you have a safety net. That means there's money left over after everything is paid for to return to your investors. And if you're investing by yourself, let's say you buy a single family house, if you have cash flow, well, yeah, that's nice because it's in your bank, but it's also a safety net, right? Because things can happen that could impact your cash flow, right? If you don't have positive cash flow on a month-to-month or on a year-to-year basis, you're digging yourself a hole there, right? You're probably tapping into, your interest reserve or your reserves, right? So if you have all of our assets that we buy here at Headway and in the commercial real estate space, we're always going to have a bucket of reserve cash set aside for months or days that are rainy, that aren't good, right? And if you don't have positive cash flow, you have to constantly tap into that bucket of money. And guess what? That bucket of money runs dry eventually. It's not an unlimited pool of resources, right? So you want to see cash flow as a safety net. Even if you don't need the cash flow, it is a lower risk situation, a lower risk investment if you see cash flow, right? So that's really, really important, and why it matters from a passive investing standpoint. I personally am a passive investor as well, not only in our deals, but in other projects as well. And I personally don't like to invest in anything that I don't see cash flow in. Now, unless it's an investment designed to not have cash flow, for example, a new construction almost very rarely has cash flow, because you're buying the land, there's no rent coming in. You're doing all the things necessary to get the land ready. There's no money coming in. You're spending money. You're going vertical, meaning you're building, you're spending money, but there's no cash coming in. And then you sell it. Then all of the cash comes in. That's the equity pop at the end, right? It's just an upside play. But other investments, existing investments, multifamily assets, car wash, if you're investing in hard money funds, or like the Headway Income Fund, there's cash flow, right? You want to see that cash flow, and seeing that cash flow and looking at different assets, it allows you, and we mentioned this on the first slide, it gives you a comparison tool across different investments, right? So you can very quickly look at something and go, that's not enough cash flow for me. So like for me, for example, just to put you in my shoes, if somebody sends me an investment offering, it's one of the first things I look for because I like cash flow. It makes me feel good when I get that monthly or quarterly distribution and via ACH or via check in the mailbox. I like that. It makes me happy. It shows me that my money's at work. So if I see an investment and it has really low cash flow, especially from an annualized standpoint, I might hesitate and go, I don't know if this is for me. Cash flow looks kind of slim, right? So it allows you to very quickly go yes or no. Because what you don't want to do as an investor, if you're very active in the investment space in any capacity, not just in commercial real estate or multifamily, you're probably seeing a lot of investment opportunities, right? It's not uncommon that you might look at multiple investments a month and multiple investments a week. And how can you spend all your time doing due diligence on all of them? It's impossible. The first thing you have to look at is those four numbers that I mentioned on the first slide. What's my cash flow? What's my IRR? What's my average annualized return? What's my equity multiple? If those boxes aren't checked, or most of those boxes, 3 out of the 4 aren't checked for me, then I say, hey, this one's not for me. Thanks for sending it over, but I'm going to respectfully decline for now, right? So it allows you to once you understand what each number means, it allows you to very quickly look at a deal and go, do I want to spend more time looking at this and actually analyzing it, or do I just want to move on, right? So it's a great comparison tool across different investments. And last thing I want to mention about cash flow and why it's important to investors in particular, the beautiful thing about cash flow and the beautiful thing about real estate is we get to use leverage. And if you don't know what leverage is, that is just debt, right? We get to take a loan from the bank for anywhere from 50% to 75% of the value of the property. I mean, there's not a lot of investment vehicles out there that you can use leverage, that you can borrow half or more of the money that you need to buy the property and only bring 25 to 40 to 50% of the cash to the table, right? It's like buying a single family house. Think about your personal house you're buying. Most people, it's very common in residential real estate that you bring 20% down, right? Think about how amazing that is. Let's say you're buying a, $100,000 house, which doesn't exist anymore, but you get to borrow $80,000 and only bring 20 to the table, right? So it's really juicing your returns that you're not having to use all of your own capital, right? So leverage actually amplifies our returns because we're able to leverage the bank money and produce a higher average annualized return due to the leverage, right? So it's really important that you're looking at the leverage when you're looking at cash flow as well and understanding how they kind of work together. Let's talk about using cash on cash to invest, right? So when you're what I get this question all the time, and it's one of my favorite questions, is because it's constantly changing from year to year, give or take. Is what is a good cash on cash for multifamily? So how should you be using this number now that you have this newfound knowledge about what cash on cash is? What is a good cash on cash for multifamily today? And I will start by saying that is very subjective, right? Some people are looking for things that don't exist. And I love being honest with people. It's just the best way to do business. If I get on a call with an investor and they tell me like, hey, Brian, I'm looking for, 12% cash on cash return, year one, and then I'm going to say, hey, Mr. John, I really appreciate your time, but we don't provide those types of investment opportunities. Unfortunately, our cash on cash is more between this and this, right? And you just got to be frank with them, right? So you have to understand like where the market is in any type of given situation, and it's subjective because some people need higher returns. Maybe they're approaching retirement, or maybe they're just chasing a higher yield. They love getting higher yields and trying to find creative ways to get 10, 15, 20% cash on cash return. I will tell you, in today's multifamily space, what we're seeing, being very active in the field, is that most assets, depending on the quality of the asset, we're going to talk about this bullet point list here in a second, and why each one of these is so important. What we're typically seeing is anywhere from 5 to 8% cash on cash, where on an annualized average basis, you want to see somewhere between 7 and 8, meaning when the project's all said and done, if you held it for 3 to 5 years, blended, you want to see somewhere between 6 and 8, 7 and 8. But it's not uncommon that year one is a little softer. So your first year of cash on cash is commonly lower because the year one is so important. You're acquiring the asset, you're kicking out all the bad tenants, you're renovating the units, you're upgrading the units, you're pushing the rents, you're increasing your amenities, and you're improving your amenities, you're starting to improve your other income, you're starting to charge the fees that are supposed to be charged when it comes to managing these assets. That is going to lower your cash on cash because you're spending a lot of money and you're probably increasing you're decreasing your occupancy, not increasing. So your occupancy is going down while you're cleaning up the property, and that could take 12 to 24 months, right? So year one, if not half a year two, is typically a little lower. So you might see 4% cash on cash, 5% cash on cash, ideally at least 5 in my opinion. But after that, you're going to see it go up, and you want to see it go up. You definitely don't want to see cash on cash go down. The only time you'll see cash on cash go down through the life cycle of a deal, if it's a longer term deal, especially if it's 7 to 10 years, is if there's a refinance in it, right? If you refinance and you pull out some of your money, you're going to get a new loan on the asset, which means your cash flow is going to go down, right? So, but you never want to invest in a deal, in my opinion, that has like a refinance modeled, meaning the deal only works if there's a refinance in it. So ideally, you want to see, slightly softer cash flow the first couple years as the property is getting improved, and then you really want to start to see really healthy cash flow year, 18 months, 24 months, and then year 3, year 4, year 5. And healthy cash flow for me, in my opinion, again, what I'm looking for, and everybody's looking for something different, but what we're seeing in the market is you really want to see between that 6 to 8%. Especially you want to get closer to the 7 and 8% the longer you hold the property, right? So year 3, year 4, year 5, you really want to see that 7, 8% cash on cash return. At least that's what I like to see. I want to see close. It's not going to be exact, right? So if I'm looking for 7% and I see 6.99, I'm not going to say, oh, that's a bad deal. It's not 7%, right? It's really, really, really close. So the one thing I do want to mention about cash on cash is a lot of people make a big mistake, and it's actually similar with all the numbers, the IRR, the AAR, average annualized return, and then the equity multiple, is they make a mistake, and this is a huge mistake. So write this down if you're new, of chasing one of those numbers, right? So what that means is they're only looking at one of those numbers and they're chasing yield. You'll probably hear that if you're an investor. You'll hear somebody say, "Oh, that person likes to chase yield. He's a yield chaser," and it doesn't always mean it's a bad thing. It means it's somebody who's always looking for yield. They're always looking for cash flow. Not bad, but what I'm encouraging you, or warning you, I should say, is don't only chase yield. And what I mean by that is don't only look at the cash flow number, right? Because it can be very, very, very misleading. And what do I mean by that? What do I mean by, do only be chasing yield? Some investments, if you're not doing enough due diligence, could show unusually high cash on cash returns without justified operational data, which basically means it's a higher risk investment, right? So in the multifamily space, we just spent some time talking about how the normal cash flow we're seeing in today's market is between 5 and 8%. With me personally, I like to see between 6 and 8%. So now knowing that, if you see a deal that has 12%, 10%, 12%, 15% cash on cash in a multifamily deal, it doesn't mean it's a bad deal and you should run away. It means that you need to do really deep due diligence on how they got to that number, right? Because if you see a higher cash on cash number, it could just basically be a red flag that it's a higher risk type of investment, right? So really, really important that you're not just chasing cash on cash just for the number. Like, don't look at 2 deals and say this one's got 10 or this one's got 8% cash on cash, and this one's got 6% cash on cash. Therefore, this one's better. That's just not how it works. There's a lot of other things that you need to take into account when looking at cash and cash, and let's talk about some of those. I put 5 of them on here. There's arguably much more, but these are the 5 that really come to mind when I'm talking to investors and when I'm thinking about investing that impact how I feel about the cash on cash. So the first thing has to do with who's the sponsor, right? So who is the sponsor that is actually running the deal? Who's the person? What's their track record, right? Do they have experience actually managing these types of assets? Those 2 things are so important because if you see a deal that has high cash on cash, right? And it's an inexperienced operator that doesn't have a track record, they've never done that before, that's a three strikes you're out for me personally. I don't want to invest in a deal that's high cash flow, which means it's probably higher risk. The person that's doing it doesn't have a track record. They've either never done this before, or maybe they're new to this, right? And then they don't have the experience of actually executing a business plan. They've never managed this type of asset before. That's a high risk situation. And if you're just chasing the cash on cash and you don't look at the track record and the experience, you could have a lot of regrets, right? So something to keep in mind. The third thing is the management, right? And what do I mean by management? Well, in commercial real estate, you have to have a property manager. It's impossible to try to do it on your own, right? Like I can't go and sit in the leasing office and take all the maintenance requests and sign all the leases and collect all the checks and deal with all the vendors and do all the bookkeeping. It's just impossible. You have a manager on site, right? And you have a management company very often. Now, we here at Headway, we're vertical. We own our own management company. We don't use third-party managers to run our Houston-based assets. We manage 1,300 units ourselves out of our portfolio. But if you do use a third-party manager, which is necessary sometimes, it's not bad to use a third-party manager. You do have to look at who's managing the property, right? If you see high cash on cash, and then you look at the manager and see like the manager is somebody that does not have a good track record, you need to do due diligence on that management company or on that person managing it, then that's a big red flag as well, right? So don't just look at the cash on cash. Look at who is managing the property. The fourth thing is location. What I have tended to seen in my experience in multifamily now for over 4 years is typically assets that are in not so great locations often show the highest cash on cash, right? And that's because, as we just talked about, high risk, right? Deals that produce higher cash flow are higher risk. And what's a higher risk? Well, it probably means that the property is not in the best location. There's higher risk that you're going to have collection issues, delinquency issues, theft on the property, crime issues, and assets that are not in great areas often can be a little more challenging to sell as well. Not impossible, but it just makes it a little bit harder because they're not in the greatest of areas, right? So location is super important when you're looking at risk mitigation when it comes to cash flow, right? So you again, just to use the same analogy, same comparison, you might have a property that has 8% cash on cash in a not so great area, and you might have a property that has 6% cash on cash or 7% cash on cash in an A area or B area. And by A and B, I mean they're pretty good areas. Well, if you're just chasing cash flow and you're just chasing yield, your natural reaction is to chase the one that's in 8%. It's much higher, right? You get extra 1 or 2%. That's nice. But it's in a not so great area, maybe a bad area. So just to be honest, right? Is that extra 1%, is that extra 2% worth the risk of a not so great location? That is up to you on this webinar today, right? So I'm not going to say it's right or wrong. Some people love to invest in areas that aren't that great because of the cash flow. They've had success doing that. They've had lots of investments that have been very successful in areas like that. So I'm not saying it's bad. I'm just saying as an investor, it's your job to look at risk, and it's our job at Headway to look at risk as well. So look at the location. It's really important. Last but not least, before we get into our Q&A here, is to look at the asset itself. Lower quality assets that need a lot of work are going to have a higher cash flow. Higher quality assets that don't need as much work, they're going to have a slightly lower cash flow, right? So to use that same analogy, the asset's really important. If you have a 1950s apartment, C minus, hasn't been renovated in 30 years, it might have a 8 or 9% cash and cash. You're like, wow, that's awesome. There's a ton of meat on the bone. That's gonna, there's upside there, high cash flow. I like that. Or you have a 1985 or 1990 product, B plus, nice area, has been renovated a few times, but maybe has still a little meat on the bone, and that one gives you 6.5%, right? So you got 8-9% versus 6.5%. Again, different quality assets. Is the risk of investing in an older product that needs a lot of work, is it worth the extra 2%? There's no right or wrong answer for that. It's just something you have to ask yourself when you're looking at investing. So again, just to recap here, track record of the operator, super important. Experience managing this type of asset, super important. the manager and management of that asset really, really, really crucial. And the location and the asset itself are all important. These are things that you have to look at when weighing, is this cash flow, is the cash on cash that I'm getting, is it worth the risk that I'm taking, right? These things are all important. So hopefully that's very educational to you when it comes to looking at investing in cash flow. So let's wrap up here, and we're going to get to some questions. I think I saw a few questions coming in, but I just want to kind of end this on a final statement. Cash flow is really important, especially in today's market. We are always chasing cash flow, but not in a bad way, but in a good way. We don't want to provide any investment alternatives to our options to our investors that does not have cash flow, because right now the market cycle has been very challenging. Everyone knows how attractive real estate was from, say, 2015, 16, all the way to 2000, first quarter 2022. Everyone wanted to invest in real estate, but there wasn't a lot of cash flow because everybody was buying. Everybody was buying properties for equity and selling very quickly, even though they weren't getting cash flow. Things have sort of reversed, right? March of 2022, the Fed started raising interest rates. We saw inflation rear its ugly head in 2021, and it's been slowing, but we're still not there yet. So in our opinion, cash flow is really important. So I would encourage you to be looking at investments that have cash flow. And we have options here at Headway for those looking for cash flow. And we're always looking for new options for those looking for cash flow. So hopefully you learned something during this webinar when it comes to cash flow. If you didn't know what cash on cash means, or COC, now you do. Let's go through real quick before we take Q&A, a little bit about what we do here at Headway, investing opportunities. So we focus on multifamily apartments. I think everyone, I see a lot of familiar names here, but if you're new to this webinar, we focus on multifamily investing. We find value add deals where we can find cash flow, we can find equity upside, we can find tax benefits, and we can multiply our investors' capital. That's our job here at Headway, and we showcase these options and present to our investors the option to invest in these deals. We also have a real estate income fund that allows you, if you love cash flow and you're like, man, I am a cash flow investor, Brian, I want cash flow, then the income fund is great for you. And that's because we'll talk about it here in a second. It provides monthly dividends. And we also occasionally, as we find opportunities with our partner, find car wash investments that are great for cash flow as well. If you want to invest with us, there is a process that you have to follow. It is really, 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 really important that you follow these steps if you want to invest with us. The first one is we do have to have a preliminary call. This is just a meeting between you and me, and you and Sid, and you or somebody on our investor team, to make sure that we understand your objectives and that we're a good fit for you. We want to make sure we're not wasting anybody's time, and we're not we got to be on the same page, right? We qualify you on this call, so we're just going to talk a little bit about your experience, your background, what you're looking for, making sure you meet the income qualifications, you actually have the capital to invest, because these are larger investments, and that you understand the timeline as well. These are typically 3 to 5 year projects, and they typically have anywhere from a $50,000 to $100,000 minimum. So we're going to talk about all that. We're going to allow you into access our private investor group. So if we have a great call and everything goes accordingly, you answer all of our questions, and we feel like we're a good fit for each other. You like what we have to offer and our services, and we feel like you're a good fit for these deals as well. We'll put you on our private investor list. And at that point, you will then get to review our offerings as they come available, and we'll present them to you. You'll sign up for them, and then you're into the deal. You're into the project, right? You invest and you are your money. So not rocket science, but those first 2 steps, the preliminary call and the qualification, really, really, really important. So if you have not had a call with me, you need to sign up for our private investors club to get that call scheduled. When you're in our private investor clubs, you get access to our events, you get access to our private webinars, get access to our private real estate deals that we present our investors. And you do have to submit an application, so please make sure you're doing that. We do usually only work with accredited investors only, so just something to keep in mind. But we do occasionally offer deals that are for non-accredited investors as well. So please scan this QR code or text me for the slide deck. I'll make sure it gets over to you to sign up for our private investor club. Last but not least, before we jump into Q&A, because we do have quite a few questions in here. It looks like I saw some questions. Yep. Our Headway Income Fund, if you like cash flow, this is our fund that we have. It's a hard money lending fund. We go out, we partner with investors, we raise capital for this fund. We deploy this capital into single family residential fix and flip loans. They're about $200,000 at a time, $200,000 each loan that we give out, and we provide our investors a solid return. So if for anything from 25 to 99,000, you get a 6% return. And most of our investors are in the 100 to 250 mark, and you would get an 8% return. So if you're looking for anywhere from a 6 to 8% return, you've got some cash sitting on the sideline, you're an accredited investor, and you want cash flow, and this pays monthly, then I would highly recommend you reach out to me about the income fund. It does not have any equity upside or tax benefits. It's strictly cash flow. So if you love cash flow, this is for you. Please reach out and take a look. Scan this QR code on your screen. Let's dive into Q&A because I did see some questions pop up. Please do not be shy. If you have any questions, put them in the box. Again, I got a QR code here. Scan it to if you want to reach out to us. So let's see what we got here. Somebody asked early before I got into it, what's a good cash on cash in today's market? I already answered that. I like to see between 5 and 8%, 5 on the lower side for year one, and then I want to see it get closer and closer to 7 to 8% throughout the life cycle of the deal. How does the financing method impact cash on cash return? Oh, that's a good question. The leverage and the debt that you take can drastically impact cash on cash, because if you take out too big of a loan, then you're paying a very, very hefty debt service, right? So if you were to somehow take out, a 90% LTV, 90% LTC, whichever one you want to use, you have a very, 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 very hefty mortgage, right? And if your mortgage payment is massive, you're not going to have a lot of cash left over at the end of the deal, right? So it's really, really important to understand how much leverage is being taken. You want to see responsible leverage. In my opinion, I like to see anywhere from 60 to 75% leverage. Right now in the market cycle, I will tell you it's really, really challenging to get 75% leverage, not impossible. But that's the sweet spot for most investment projects. Most investment projects produce healthy cash flow, healthy returns, a healthy IRR, those numbers that you saw in that 65 to 75% range. I like to see between 60 and 75% personally. The other thing to note about leverage, and we didn't really talk about this today, but the other thing to note about leverage is that the type of loan that you take can drastically impact the cash flow as well. We've seen this a lot today in today's market. So there's fixed rate loans that the interest rate never changes. And then there's floating rate loans, or what are called bridge loans, right? Where the mortgage can actually change on a month-to-month basis. So think about that. Your mortgage is X dollars this month, and then next month it's Y. It can change completely if you're on a floating rate note. What are in the residential space, if you're a residential real estate investor or a residential realtor or owner, they're often called ARMs, ARMS, adjustable rate mortgages. This is very similar in the sense that the mortgage can change on a month-to-month basis. So that can impact your cash flow, right? If interest rates shoot up, then whether you have a interest rate cap, meaning the rate can't go up past a certain amount or not, you can have your cash flow impacted, right? It might go down, and it goes the other way around too. If interest rates drop and you're on an adjustable rate mortgage, your cash flow can actually go up, which would be great, right? So it is important to look at the financing when it comes to cash flow and what type of risk is associated with the cash flow. And if I'm investing in a deal that has floating rate debt, it's not a bad thing necessarily, but you want to make sure you understand the risk how that can impact the cash flow throughout the life cycle. Are there scenarios where cash on cash return might not be useful? Yeah, I would say I think I kind of alluded to that a little bit in the presentation. Cash on cash is not as useful for new developments, right? New construction projects, because they typically do not have cash flow. They just have an equity upside at the end. Give me $100,000. I'm going to build a shopping center, and in 3 years, I'll give you 200 back, 2x multiple, right? 33% average annualized return. I'm doubling your money in 3 years. So 100 divided by 3 is a 33% return. Cool. No cash flow, but I get a 33% average annualized return. Awesome. I love it. Sign me up. Right. So there are some scenarios where cash on cash would not be useful, or you won't even see it in multifamily or alternative investments, in real estate in particular. And it's because those deals might not cash flow. Land investments, new construction investments, anything going vertical, there's not going to be any cash flow in this situation. So how can I improve the cash on cash return of an existing investment? Good question. That's our job. If you're passively investing with us, or you're partnering with us, it's our job to do that. So I guess a good question, I'll kind of rephrase your question, John, is how do we improve cash on cash? I kind of take the angle there. There's a lot of things that we do. One is our job is to always push income, right? So the easiest way to improve the cash on cash is make more money, not rocket science, right? So we're always pushing income. How do we push income? One, we spend money on CapEx to actually improve the property. That's going to be interior renovations, exterior renovations, amenities, different ways, adding covered parking, different things that we can allow us to charge more money for the residents to live and pay more rent. The other thing is other income, which I kind of mentioned on the last one. So other income are ancillary sources for us to basically collect other small increments of cash, other small increments of income. So I'll give you some examples: application fees, background check fees, covered parking, reserve parking, amenity fees, valet trash. There's a lot of different fees that come in apartment complexes, and those aren't all applicable in one spot. A lot of new properties will have amenity fees, older properties won't. So it just really depends on the asset and the asset type and the area and the market as well. But that's how we improve cash on cash. In one way is we improve income. The second way is we're really, really, really conscious of our expenses, right? I'm not going to say we're cutting expenses because, and that is a part of the formula, but you cannot cut your way to prosperity. If you cut too many expenses, that's a bad thing. It probably impacts your residents, right? If you're not cutting the grass because you want to save money on landscaping, bad. If you're cutting the trash service because you don't want trash picked up every day because it costs money to get trash picked up every day, bad. If you're not having enough staff in the office, you want to fire somebody or slim your staff because you don't want to pay that extra person that extra, $40,000-$50,000 a year, bad. It affects customer service. If you normally have 3 maintenance guys, but you want to cut labor and you want to go to 2 to save money, bad. That affects your ability to, actually service maintenance tickets, right? So we improve the expenses in other ways. We try to be efficient with our expenses, right? So cutting things that are unnecessary. There's a lot of hidden costs when it comes to managing these businesses. Because they are businesses, they're not just real estate. People don't think of it that way. You're managing a business. So we're very creative when it comes to finding creative avenues to cut expenses or to optimize expenses, I should say, right? It could be sharing resources. We have a lot of properties that are right next to each other. So that is a great way to optimize expenses. We're not cutting expenses necessarily, but we're optimizing. We're able to share resources. Maybe we have somebody that works for us that helps, like a porter, somebody who basically picks up trash, kind of helps with miscellaneous tasks around the property. Well, maybe that one person can now work at 2 properties because they're 5 minutes from each other. Well, now that one person's salary, maybe they're making 20, $25 an hour. You're not having to put that all on one property. You can split it between 2. Great way to optimize expenses, right? Let's see what else we got here. What are some common mistakes investors make when investing in their first asset? That's a good question. I wouldn't say necessarily it applies to cash on cash. Common mistakes investors make when investing in their first project. One, only looking at the numbers. I think that's probably the most common one. They only look at the numbers. So they're like, oh, 8% cash on cash, 17% IRR, 25% average annualized return, 2.25x multiple. That sounds good. I'll sign up. Here's $100,000. Okay. So that's one, I would say mistake. I think you need to do more due diligence, right? So asking smart questions. Tell me about the property. Tell me about the business plan. Why did you guys like the deal? Doing due diligence on the sponsor. How long have you guys been around? How many deals have you invested in? Tell me about your other properties. Are you guys familiar with the market? So asking really smart questions. So not doing enough due diligence and only look at the numbers. I think that's a big common mistake we see investors make. Another common mistake I see investors make is they don't necessarily diversify across properties. I've heard a lot of stories of, especially over the last few years, where somebody put too much money in one property versus spreading it out. And, here's the reality. These are investments, right? There's risk involved with them. It is no guarantee that you will not lose your money, right? I always tell our investors that, look, we're going to work our butts off and to protect our investors' capital. But nothing in life is guaranteed. Things happen sometimes, like COVID. Let's give COVID an example. Who's to predict that COVID would have ever happened? Does anybody have a crystal ball and saw that coming? No. All hundreds of thousands of businesses across the US went out of business when COVID hit. Did they do something wrong? No, they didn't. It was the state of the economy at the time, right? So things could happen when you make an investment. Same with the stock, right? You invest in a stock, it's going up, 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 up. Guess what? Market could crash tomorrow. Is that your fault? Is that somebody else's fault? It's nobody's fault. It's the state of the market, right? Things that are out of your control. So that happens in real estate as well. Now, the beautiful thing about it is we do have a lot of variables we can control, and we're conscious of that. But it's a big mistake to assume that a deal is always going to work, right? So I always tell investors, if you've got, let's say you've got $500,000 in cash, and you say, hey, look, I want to park this bucket of money in real estate. I would highly encourage you to diversify as much as possible, right? So instead of sticking 500K in one deal, stick 250K in two deals, right? Or stick 100K into five different deals, right? Diversify. Maybe one's multifamily, maybe one's in the income fund, maybe one's in a car wash. Maybe you find another great investment into self-storage or something with another firm. There's so many different options out there. We always encourage our investors to diversify so that they don't have all their eggs in one basket. And then I'll say last but not least, before we kind of wrap this up, I don't see any other questions on here, is not having a long enough outlook. I think it's easy to panic when you see short-term losses, right? It's just like the stock market. I'm not a stock market expert. I'm not super active in that, but I know one of the things you typically don't want to do is you don't want to sell on the way down. And just like you don't want to buy on the way up and get FOMO and buy at you end up buying at the top typically, you don't want to sell when it hits rock bottom, unless you want to take the tax losses. You have to understand that it's a long-term investment, right? If you continue to hold, as long as you're investing in something solid, great company or a great real estate project, it's very unlikely that things don't come back up, right? So as long as you're working with an experienced operator, and working with somebody who's well capitalized, and the deal is this great deal in a great location, you just have to hold on. You have to go through the market cycle. Sometimes things aren't going to always be great. You're going to have good months. You're going to have bad months. You can have, unfortunately, sometimes a bad year. You can have good years, right? So the understand that these are long-term investments. Things aren't going to be perfect from month to month. Emergencies are going to happen. Accidents are going to happen on the property. These are businesses, right? People live there. There's going to be leaks and there's going to be electrical issues. There's going to be things like that that you don't have to deal with. We deal with that, but we notify our investors, and everything's not going to always be perfect, but these are long-term investments. So remember, our goal is to always buy these properties and hold them for 3 years or less, ideally. But our goal is to never, or is to always plan to hold them for 5, right? So these are long-term investments. So just something to keep in mind. I think that's another mistake investors make, is they get short-sighted, right? So I will end this webinar. Good timing, right under the hour mark here. I don't see any other questions coming in. I want to thank everybody for coming tonight, and I want to thank for all the amount of people that actually hung around. It's a good crowd here today. If you want to get involved, and if you want to invest with us at Headway, again, shoot me an email, brian@headwaycapital.us, or you can email investor@headwaycapital.us. Scan the QR code that you see on your screen as well. Let's hop on a call. I'd love to discuss with you upcoming investment opportunities. We do have some exciting things in the pipeline that I think would get you excited if you like the idea of investing in multifamily. And then if you're interested in the income fund and you want immediate cash flow today, and you have some cash sitting on the sidelines, please scan the QR code for this income fund. I think this will be something that you'll be very interested in learning more about. I'd love to chat with you about it. No pressure, but it's a great opportunity to get on a call with me and learn. Thank everyone for attending tonight. I will see you on our next Passive Investor webinar series. Have a great day.